Most people don't fail at investing because they pick bad assets. They fail because they invest in the wrong order. That's the uncomfortable truth. You can buy the right stock, the right crypto, the right fund, and still end up poorer than someone who never touched a chart in their life. Because money isn't just about returns. It's about sequencing. And the order you invest in quietly decides whether compounding works for you or against you. This matters right now because access to investing has never been easier. One tap and you're in the market. But access without order is how people take risk before they're paid for it. So let's slow this down. Not as advice, as a system. Before the first dollar is invested, there's a step almost everyone skips. Not because it's boring, but because it doesn't look like investing. The first investment isn't stocks. It's stability. If a flat tire can force you to sell assets at the worst possible time, you're not investing, you're gambling with timing. This is why emergency cash exists. Not to earn returns, but to protect every future return you'll ever earn. It's insurance against panic. Miss this step and the market controls your behavior. Complete it and you control your timing. That difference is invisible until it isn't. Next comes the most mathematically brutal step in the entire system. High-interest debt, credit cards, personal loans, anything charging double-digit interest. People treat debt payoff like a moral issue. It's not. It's arithmetic. Earning 7% while paying 18% isn't diversification. It's loss disguised as activity. Every dollar used to kill high-interest debt earns a guaranteed, tax-free return equal to the interest rate. No market crash can take that away. Yet this step gets skipped constantly. Why? Because paying debt doesn't feel like progress. There's no app notification, no chart going up, just silence. And silence doesn't sell. Only after stability and debt are handled does real investing begin. This is where people expect excitement. They imagine picking winners. But the smartest investors start with something far less dramatic. Broad exposure. Not because it's clever, because it admits a hard truth. You don't know which company wins. You don't know which sector dominates. And neither does anyone else consistently. So instead of trying to predict the future, you buy a claim on growth itself. Markets rise not because of genius, but because humans keep producing more than they did before. Index-style investing isn't lazy. It's skeptical. It assumes you're not special and builds wealth anyway. Here's where the story gets interesting. Once your base is built, people rush to the next shiny thing. But the next step isn't more risk. It's tax awareness. This is the part nobody likes talking about because it's invisible. Two investors can earn the same return and end up with wildly different outcomes. Not because one invested better, but because one leaked less to taxes. Tax-advantaged accounts, timing, asset placement. None of it feels exciting. But over decades, taxes can quietly claim more than market crashes ever will. The system doesn't reward the bold here. It rewards the patient and the boring. Only now, much later than most expect, does concentrated risk make sense. Individual stocks, speculative assets, high volatility plays. This is the stage people want to start with, because this is where stories live. But stories ignore survivorship. For every winner screenshot, there are thousands of quiet losses you'll never see. Speculation works best when failure doesn't matter. That requires a foundation strong enough to absorb it. Otherwise, risk isn't asymmetric. It's terminal. Here's the uncomfortable incentive hiding underneath all of this. Platforms don't make money when you build stability. They make money when you trade. Content doesn't go viral when you pay down debt. It goes viral when something changes your life. The system rewards motion, not order. So people jump steps. They invest upside before removing fragility. And fragility always shows up eventually, usually at the worst possible moment. Zoom out far enough and a pattern appears. The people who seem lucky with money rarely did anything dramatic. They just respected sequence. They built buffers before risk. They removed leaks before chasing growth. They let time do the heavy lifting. While others were busy optimizing returns, they were optimizing survival. And survival compounds. There's a wider implication here that rarely gets discussed. We talk about financial literacy as knowledge. But the real divide isn't knowledge. It's patience. The willingness to do the unphotogenic steps first. To delay excitement. To trust math more than narratives. That's not a personality trait. It's a structural advantage. So what is the smartest order to invest your money? It's not a list of assets. It's a progression of risks. First, protect yourself from randomness. Then remove guaranteed losses. Then buy growth broadly. Then optimize friction. And only then take shots. Anything else is skipping the boring steps and hoping luck fills the gap. Sometimes it does. Most of the time, it doesn't. So here's the question worth ending on. If investing success is mostly about order, and almost no one talks about order, who benefits from keeping that part quiet?